Hi, welcome to this week's video blog. My name is Christian Harris. Quite often we have customers or consumers out there who send us email, ask us questions about obviously the mortgage industry. So I thought we'd answer a few of those here today, and apologize if we didn't get to yours, but keep them coming. So a few of them, one was an anonymous person asked us why their bank would offer MonsterMortgage.ca a rate that's 3.89% when that same institution's offering them 3.99%. So great question, and the answer probably is that as a broker, we're dealing in volume. To us and to that lender, we represent hundreds of millions of dollars, and whereas a lot of institutions look at a client as just one mortgage. So because we deal in volume and bulk, we tend to get offers slightly better than the consumer can get at their institution. So hopefully that answered your question, but yes, we deal in quite a bit of volume, and sometimes that gives us the benefit where we get a slightly better rate than maybe the public would get at that same institution for the same product. Second question, Luke writes in, what's the difference between a mortgage with a collateral charge and a regular mortgage? How does this affect me? It's a very good question. Collateral charge simply means, it means a few things, but it's not transferable. So you cannot move that mortgage from that institution to another one. Typically with mortgages, if you have a regular charge, you can take a 3-year term. At the end of that 3 years, you can transfer it over to another institution at no cost. There's no new legal fees that have to be done. When there's a collateral charge, it is not transferable. So at the end of that 3 years, if you wanted to move it from institution A to institution B, you would incur fees to do that. Third one, we have Jim asks, my bank quoted me a penalty of $4,100 to discharge my mortgage. He has about 2.5 years left, but the bank that he was going to said that they calculated that same penalty amount to only be $2,400. Why is this, and do I have any recourse? So again, the institution he's with said your penalty is $4,100, and the institution he's going to thinks it should only be $2,400. Why is this, and what is my recourse? The answer is the institution you're with is probably right. The one you're going to is probably not correct. Each bank can calculate penalties different ways. Typically a 3-month interest penalty is pretty straightforward and standard. However, if you're looking at an interest rate differential penalty, different institutions calculate that differently, and I'm not going to go into how they do it because there's a few different factors, and 28 months remaining tells me that it is an interest rate differential penalty. So Jim H., your existing institution is right. They're the ones who are quoting you the penalty, and your new institution, they should know that not every institution calculates that penalty the same way. So I would believe your bank who's telling you it's $4,100 and use that number to make sure that it makes financial sense to pay that penalty. And if you have any further questions about that, Jim H., you can give us a call here, and we can definitely go through that calculation, see if it makes sense to break your existing mortgage. Obviously we don't have your mortgage amount, but those are the things we need, and your interest rate, and we can see if it makes sense to do. Alright, thank you for watching this week's video blog. Again, any questions you have, please email them in to us, and we'll do our best to get back to all of them. Thank you.